Welcome to the Riskwiser Zone. I'm your host, Louie. Today, we're diving into the volatile world of oil prices, where conflicting reports about shipping in the Strait of Hormuz have sent crude oil costs on a wild ride. We've seen U.S. West Texas Intermediate crude oil plunge as much as 19%, slipping below $77 per barrel at one point, only to climb back up to around $89 a barrel. International Brent crude also briefly dropped 17% to below $80 per barrel, but later rose back to more than $90 per barrel. The cause of this volatility? A social media post from U.S. Energy Secretary Chris Wright that was later deleted and denied by the White House, claiming the U.S. Navy successfully escorted an oil tanker through the Strait of Hormuz to ensure oil remains flowing to global markets. However, a spokesperson for the agency blamed Department of Energy staff for having incorrectly captioned a video of Wright. The White House has since clarified that the U.S. Navy has not escorted a tanker or a vessel at this time, although the offer of a U.S. escort remains available to ships in the strait. Security for oil tankers in the Strait of Hormuz has quickly emerged as the key factor affecting the supply and price of crude oil around the world. The situation is being closely monitored by leaders of the Group of 7 leading industrial nations, who plan to convene for a virtual meeting to discuss coordination on global energy supplies. Energy ministers from leading industrialized nations have also met to discuss options to respond to rising crude oil prices, including a potential strategic release of petroleum reserves. As the world waits to see how this situation unfolds, one thing is clear: the impact on retail gas prices has already been significant, with a rise of 50 cents since the war started. We'll continue to follow this story and bring you updates as more information becomes available. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and global events that could impact your investments and economic outlook. Today, we're focusing on the recent fluctuations in the oil market due to the ongoing conflict in the Middle East. The situation is complex, with prices seesawing based on rapidly shifting comments from the Trump administration regarding the war in Iran. The conflict has already led to significant spikes in oil prices, reaching nearly US $20 per barrel at one point, its most expensive level since 2022. However, after President Trump suggested that the war might be nearing its end, prices plummeted. The uncertainty is palpable, with Iran launching new attacks and the US threatening to take action against any attempts to lay mines in the Strait of Hormuz. This volatility not only affects oil prices but also has broader implications for the global economy. If oil prices remain high for an extended period, it could lead to increased costs for households and businesses, potentially resulting in a scenario known as stagflation, where economic growth stagnates while inflation remains high. In response to these developments, the Australian market has seen mixed reactions. The ASX has experienced some positive trading sessions, with certain sectors like energy benefiting from the higher oil prices. However, other areas, such as technology and real estate investment trusts, have been more cautious due to concerns about the potential economic slowdown. It's essential for investors to remain vigilant and consider diversifying their portfolios to mitigate risks associated with geopolitical uncertainties. The Reserve Bank of Australia is also closely monitoring the situation, ready to adjust monetary policies if necessary to support the economy. As we navigate these uncertain times, it's crucial to stay informed about global events and their potential impact on our financial landscape. We'll continue to bring you updates and analysis to help you make more informed decisions. Welcome back to the Riskwiser Zone. As we wrap up today's show, we're taking a closer look at the ongoing conflict in the Middle East and its far-reaching implications on global markets and industries. The recent escalation of tensions has sent shockwaves through various sectors, including energy, tourism, and finance. Let's start with the energy sector, where Indian refiners have been forced to slash their Russian oil imports due to new sanctions. This move marks a significant pullback by India, which has been Russia's largest buyer since 2022. The shift is likely to impact Russia's economy, which relies heavily on oil exports. Meanwhile, in the tourism industry, Russian tour operators have lost approximately $37 million in just the first 10 days of the conflict. The financial hit stems from the cost of evacuating tens of thousands of tourists and dealing with mass trip cancellations. With many Russians still stranded abroad, the industry's biggest financial blow may still lie ahead as companies prepare to refund customers for canceled trips. As we navigate these complex and interconnected events, it's essential to remember that geopolitical shocks can have a ripple effect on global markets. Investors should remain cautious and stay informed about the latest developments. In conclusion, the situation in the Middle East serves as a reminder of the importance of diversification and risk management in investment portfolios. As we continue to monitor the situation, it's crucial to maintain a balanced perspective and avoid making emotional decisions based on short-term market fluctuations. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.